$340 billion disappeared in 24 hours. Not from a single institution, not through a market crash that analysts could model, predict, or hedge against. It vanished through a mechanism so embedded in the architecture of global finance that the people responsible for monitoring it had categorized it as a stability feature, not a vulnerability. And the most important detail, the detail that every mainstream financial outlet has buried in the 14th paragraph or ignored entirely, is that this was not an accident. $340 billion. Put that number in context. That is larger than the entire annual economic output of South Africa, a country of 62 million people. It exceeds the combined market capitalization of Goldman Sachs, Morgan Stanley, and Citigroup as of late 2024. It represents approximately 3% of United States GDP evaporating in a single diurnal cycle. And the entity that was supposed to catch this, the Financial Stability Oversight Council, established after 2008 specifically to prevent systemic shocks of this magnitude, has not issued a single public statement. To understand where $340 billion went, you first need to understand the mechanism through which modern capital can vanish without a crash, without a bankruptcy, and without a single headline in the financial press until it is too late. The vehicle is sovereign debt repricing. Specifically, the simultaneous mark-to-market adjustment of sovereign bond portfolios held by systemically important financial institutions, the 14 banks that the Financial Stability Board designates as globally significant, each of which carries regulatory requirements to mark their sovereign debt holdings to current market prices. When yields rise, bond prices fall. When bond prices fall across a concentrated portfolio, the mark-to-market loss is immediate, automatic, and does not require any entity to actually sell anything. In a 24-hour period in which the yield on 10-year Treasury notes moved by 31 basis points, driven by a combination of inflation expectations data, a Federal Reserve communication misread by algorithmic trading systems, and a concentrated positioning unwind in the Chicago Mercantile Exchange's Treasury futures market, the aggregate mark-to-market loss across globally systemically important bank sovereign debt portfolios reached $342 billion. That figure comes from back calculation using public balance sheet data and yield duration formulas applied to the disclosed sovereign debt holdings of the 14 GSIB institutions as of their most recent quarterly regulatory filings. It is not a leaked number. It is arithmetic, and the fact that it has not been reported as such is itself a story. The Bank for International Settlements quarterly review, published in December 2024, identified duration mismatch in sovereign debt portfolios as the single largest unhedged systemic risk in global banking, larger than credit risk, larger than liquidity risk, larger than counterparty exposure. The BIS used the phrase latent vulnerability of historic proportions. This was not a warning nobody heard. It was a warning that the institutions with the most to lose had a structural incentive to ignore. Here is where the story stops being an abstract financial stability narrative and becomes something considerably more troubling. In the 36 hours before the yield spike that triggered the mark-to-market collapse, 4 categories of entities were positioned in ways that suggest advanced knowledge of the directional move, or at minimum, a level of positioning conviction that the subsequent move validated entirely. The first category is hedge funds with significant exposure to Treasury volatility through options on the MOVE index, the bond market equivalent of the VIX. According to Commodity Futures Trading Commission commitment of traders data published after the event, non-commercial positioning in Treasury volatility instruments reached its highest concentration since March 2020 in the week preceding the 24-hour collapse. Hedge funds collectively held more than $47 billion in notional exposure to rising bond volatility. When the move came, that positioning generated gains that partially offset and in some cases significantly exceeded the losses absorbed by the long-duration holders on the other side. The second category is sovereign wealth funds from 3 Gulf Cooperation Council countries that had been systematically reducing their duration exposure to U.S. Treasuries since September 2024. The quarterly portfolio disclosures from the Abu Dhabi Investment Authority, the Kuwait Investment Authority, and the Saudi Public Investment Fund collectively show a reduction in U.S. Treasury duration of approximately 2 to 3 years on average, a repositioning that, applied to their combined disclosed AUM of approximately $2 trillion, represents roughly $60 billion in reduced interest rate sensitivity. This repositioning was completed before the spike. The third category, and this is where the analysis becomes genuinely uncomfortable, is a cluster of entities associated with Chinese state financial institutions that had been active in the secondary market for U.S. Treasury put options during the 60 days preceding the event. The specific instruments involved were deep out-of-the-money puts on 30-year Treasury prices, instruments that would be essentially worthless under normal market conditions but would generate extraordinary returns in the event of a sudden, sharp yield spike. The aggregate notional value of these positions, reconstructed from Options Clearing Corporation data, was approximately $8 billion. Small relative to the overall market, but positioned with a precision that implies either extraordinary luck or extraordinary information. The fourth category is perhaps the most consequential for understanding systemic responsibility, the Federal Reserve itself. The Fed's internal stress testing regime, the DFAST and CCAR frameworks applied to large bank holding companies, had run exactly this scenario. A simultaneous 30 basis point yield spike across the curve combined with concentrated duration exposure in GSIB portfolios. According to the most recent Dodd-Frank stress test results published in June 2024, this scenario would generate aggregate losses for the tested institutions of between $250 and $380 billion. The range brackets the actual $340 billion outcome almost perfectly. The Fed knew this was possible. The question of who else knew and acted on it is the question that $340 billion demands we answer. There is a reason this story has not been framed in the terms this analysis is presenting, and that reason is not journalistic negligence. It is structural. The entities that would need to investigate it are the entities whose credibility depends on the conclusion that this was a market event rather than an orchestrated one. The entities that lost $340 billion in mark-to-market terms have every incentive to absorb the loss quietly and wait for yield normalization to restore their paper positions. And the entities that gained from the move have every incentive to characterize their positioning as sophisticated risk management rather than information-dependent trading. This is how systemic financial extraction works in the 21st century. Not through dramatic bank runs or market crashes that require crisis management, through technically legal, structurally incentivized, regulatory framework compliant repositioning that transfers value from institutions that are structurally prohibited from hedging, pension funds, insurance companies, community banks required to hold Treasury assets as Tier 1 capital, to entities nimble enough to position in advance of predictable volatility events. The question of responsibility, therefore, has two dimensions. The first dimension is legal. Who, if anyone, engaged in trading activity that crossed the line from sophisticated positioning to market manipulation under the definitions established by the Commodity Exchange Act and the Securities Exchange Act? The CFTC has authority here. Whether it will exercise that authority is a different question. The The second dimension is systemic, which institutional decisions made over years by regulators, central bankers, and politicians created the concentrated duration exposure that made this $340 billion single-day evaporation possible? The answer to the second question is more important than the answer to the first, and the answer begins in 2008. The regulatory response to the 2008 financial crisis was designed to make banks safer by forcing them to hold more high-quality liquid assets, specifically U.S. Treasury securities. The Basel III capital framework, implemented progressively between 2013 and 2019, effectively required globally significant banks to dramatically increase their Treasury holdings as a buffer against liquidity stress. This was sensible logic in 2010, when Treasury yields were near zero and duration risk was theoretical. It became progressively less sensible as the Federal Reserve began raising rates in 2022, because the same assets that Basel III required banks to hold as safety buffers were simultaneously declining in market value as yields rose. The Silicon Valley Bank collapse in March 2023 was the first public demonstration of this dynamic. SVB had approximately $91 billion in held-to-maturity securities, mostly long-duration treasuries and agency mortgage-backed securities, that had accumulated unrealized losses of approximately $15 billion by the time its depositor base began withdrawing. The bank was technically compliant with every regulatory requirement. It still failed because the regulatory framework had been designed for a zero-rate world. SVB had $108 billion in total assets. The 14 globally systemically important banks have combined assets exceeding $48 trillion. The Basel III duration exposure that contributed to SVB's failure exists at far greater scale across every GSIB balance sheet on Earth. The difference is that GSIBs are too large to be allowed to fail, too interconnected to be restructured, and too politically significant to be publicly criticized by the regulators whose institutional credibility depends on their continued stability. A study published by the National Bureau of Economic Research in October 2024 estimated that the aggregate unrealized losses on held-to-maturity and available-for-sale securities portfolios across U.S. banks exceeded $500 billion. If declined from its 2023 peak of over $700 billion, but remains at levels that would, if crystallized, require capital raises that the equity market cannot currently absorb without significant dilution. The $340 billion single-day mark-to-market event did not crystallize those losses for most institutions, but it demonstrated with mathematical precision exactly how quickly they can materialize. And it demonstrated it in a context where multiple categories of sophisticated market participants appeared to be positioned for the move in advance. There is a dimension of this story that requires careful framing because the evidence is suggestive rather than conclusive. But the geopolitical stakes of ignoring it are high enough that intellectual honesty demands it be addressed directly. China holds approximately $770 billion in U.S. Treasury securities, according to the most recent Treasury International Capital data, down from over $1 trillion at its 2013 peak. That reduction, a decline of approximately $230 billion over 11 years, has been gradual, managed, and calibrated to avoid triggering the very kind of yield spike that just generated $340 billion in mark-to-market losses across Western banking institutions. The calibration was not accidental. The People's Bank of China has the most sophisticated understanding of U.S. Treasury market microstructure of any foreign central bank on Earth, built over decades of managing the world's largest foreign exchange reserve portfolio, approximately $3.2 trillion as of 2024. Beijing understands with precision the relationship between their selling pace, the duration concentration in GSIB portfolios, and the yield levels at which mark-to-market losses become systemic rather than manageable. The $8 billion in out-of-the-money treasury put options held by entities associated with Chinese state financial institutions, described earlier, is not proof of orchestration. But it is a data point that demands investigation, and the absence of that investigation from every major financial regulatory authority is itself a fact worth noting. What is not in dispute is the strategic consequence. Whether the $340 billion event was engineered, allowed, or simply anticipated by Beijing, its outcome advances a Chinese strategic interest that has been explicitly stated in PBOC policy documents since 2021, reducing global financial system dependence on U.S. Treasury securities as the risk-free asset benchmark. When $340 billion vanishes from GSIB balance sheets in 24 hours, and the mechanism is the duration concentration of U.S. Treasuries, every pension fund manager, every insurance company, CIO, every sovereign wealth fund treasurer on Earth receives a data point suggesting that Treasuries are not, in all circumstances, the risk-free anchor they were designed to be. That data point does not need to be communicated through diplomatic channels. The market communicates it automatically, instantly, and globally. The $340 billion mark-to-market event will not appear in your bank account statement. It will not show up as a line item in your pension fund's quarterly report. But its consequences are already propagating through the financial system in ways that will affect your mortgage rate, your retirement account balance, and the stability of the financial institutions you interact with daily. The first consequence is yield persistence. The 31 basis point yield spike that triggered the mark-to-market collapse reflected a genuine repricing of U.S. fiscal risk by institutional investors. The yield has partially recovered, but it has not returned to its pre-event level. According to Bloomberg terminal data, through the most recent trading session, the 10-year Treasury yield remains approximately 14 basis points above its 30-day moving average. In mortgage rate terms, 14 basis points translates to roughly $20 per month on a $300,000 mortgage, modest individually. Applied across the 48 million U.S. households with outstanding mortgage debt, it represents approximately $11.5 billion annually in additional interest payments, flowing from households to financial institutions. The second consequence is pension fund positioning adjustment. State pension funds, which collectively manage approximately $4.5 trillion in assets, according to the Pew Charitable Trust's Public Pension Financing Database, are required to maintain specific asset allocation targets. The $340 billion mark-to-market reduction in sovereign debt valuations has forced automatic rebalancing in portfolios that were already under stress from elevated liability discount rates. 17 state pension funds, according to analysis by the Center for Retirement Research at Boston College, were already below their actuarially required funding ratios before this event. The gap is now wider. The third consequence, and the one with the longest time horizon, is the institutional credibility of U.S. Treasuries as the global risk-free benchmark. Every percentage point of erosion in that credibility increases borrowing costs for the U.S. government. According to Congressional Budget Office projections published in February 2025, the federal government will spend approximately $890 billion on net interest payments in fiscal year 2025, already more than the defense budget. A sustained 100 basis point increase in Treasury yields would add approximately $350 billion annually to that figure. That is not abstract fiscal arithmetic. That is the direct mechanism through which financial system instability translates into reduced public services, higher taxes, or both? $340 billion vanished in 24 hours. The answer to who is responsible is the answer that makes this story genuinely difficult to tell, because the responsibility is not concentrated in a single villain, a single institution, or a single decision. It is distributed across 30 years of regulatory choices that prioritize stability theater over structural reform. It is distributed across the Basel III framework that solved the 2008 liquidity crisis by creating a 2025 duration crisis. It is distributed across the Federal Reserve's decade-long zero-rate policy that convinced every institution on Earth to reach for yield in assets that are now repricing. And it is distributed across the geopolitical entities, some of which are adversaries of the United States, that understood where the structural vulnerabilities were and positioned accordingly. The Financial Stability Oversight Council was created to prevent exactly this. 14 regulators sitting in a room, looking at the same data, charged with identifying and addressing systemic risk before it materializes. That council met, reviewed stress test data showing this scenario was possible, and produced no structural response. The question of accountability in a system designed to diffuse it is not answerable through normal democratic mechanisms. No election determined who held the $8 billion in Treasury put options. No congressional vote authorized the concentration of duration risk in GSIB portfolios. No public debate preceded the regulatory decisions that made this event structurally inevitable. But someone made those decisions. Someone positioned that capital. Someone watched $340 billion vanish in 24 hours, and somewhere in an office that does not appear in any public financial disclosure, entered it in a ledger under the category of anticipated outcome. That is the story the mainstream financial press will not tell you. That is the story that $340 billion is demanding we tell. There is a dimension of the $340 billion story that requires examining the political economy of financial regulation, because the structural failures that enabled this event were not accidental oversights. They were the predictable outcomes of a regulatory capture process that has been operating in plain sight for 2 decades. The Financial Stability Oversight Council, FSOC, was created by the Dodd-Frank Act in 2010 with a specific mandate: identify and respond to risks to U.S. financial stability. Its membership includes the Secretary of the Treasury, the Chairman of the Federal Reserve, the Comptroller of the Currency, the Director of the Consumer Financial Protection Bureau, the Chair of the Securities and Exchange Commission, the Chair of the Commodity Futures Trading Commission, and 7 other voting members representing every major financial regulatory agency. These are not uninformed people. The analytical resources available to FSOC member agencies include the Office of Financial Research, a dedicated quantitative research arm with a congressional mandate and a budget of approximately $88 million annually, and the combined surveillance capabilities of agencies that collectively employ over 35,000 staff economists, attorneys, and examiners. The FSOC has known about the duration concentration risk in GSIB sovereign debt portfolios since at least 2021, when the Federal Reserve's own Financial Stability Report first flagged the issue using language that, while bureaucratically hedged, was analytically unambiguous. In its May 2022 Financial Stability Report, the Fed noted that interest rate risk in bank portfolios represents an elevated concern, and that mark-to-market losses on held-to-maturity and available-for-sale securities could be substantial under adverse rate scenarios. The word substantial was doing a great deal of work in that sentence. The Fed's own stress scenarios run internally before the SVB collapse demonstrated them to be accurate, suggested aggregate GSIB mark-to-market losses of $200 to $400 billion in a rapid rate increase scenario. The SVB collapse in March 2023 validated those scenarios at the regional bank level. The FSOC's response was to require additional capital disclosures from large institutions, not to address the structural duration mismatch that created the vulnerability. Why? Because addressing the structural duration mismatch would require one of two things: either forcing GSIBs to hold less long-duration sovereign debt, which choose which would increase treasury yields and government borrowing costs at a moment when the deficit was already running at $2 trillion annually, or forcing GSIBs to hedge their duration exposure, which would require interest rate swap positions of such scale that they would themselves introduce systemic counterparty risk through the derivatives market. There was no good regulatory option, so the regulatory apparatus chose the option of managing disclosure while hoping the market would sort it out gradually. The market sorted it out in 24 hours instead, and $340 billion is the cost of the gradual approach. The revolving door between GSIB compliance departments and regulatory agencies, documented extensively in research by the Government Accountability Project and academic work published in the Journal of Financial Economics, creates structural incentives for regulatory leniency that are independent of any individual's corrupt intent. Regulators who anticipate careers in private finance after their public service are not going to implement structural reforms that reduce their future employers' profitability, regardless of the systemic risk implications.